Okay. Good morning. Everybody hear me okay? Good. My name is Bob Kleinknecht. I'm with Oakstone Law, as most of you know at this point. We're going to do a little presentation here, timely tax and trust tips for year end. I own and operate an estate planning firm, and that's all we do. We do estate planning and estate settlement for families who are looking to preserve wealth for their descendants. And to my left here we have Matt Schell and Randy Wright. They're both with Markham, Norton, Mosteller, Wright. Did I get that right? Yeah. And I'm going to let them introduce themselves, and then the order will be, I think Matt and Randy will start us off with some year-end income tax planning tips, and then I'll pick up in the middle and do some trust and gifting ideas, and then we'll kind of split the difference at the end. So hope you enjoy it.
Okay, I'm Matt Schell. Been a CPA and with the firm since 2002. So I'm going to jump right in, try to cover as much as we can, and well, I guess we can cover questions whenever you guys want, but I'll go through it. First thing, just wanted to mention.
Right, left.
Okay. Back when they got things kind of resolved with the fiscal cliff about a year and a half ago, 2 years ago, we finally had an idea of where things were going. So for 2013 and 14 and forward, we kind of know what kind of brackets we're looking at. So the top tax bracket used to be 35, it's back to 39.6, but as we'll jump into here in a second, there have been some additional things based on your income levels that actually make your effective rate even higher than that if you're an upper incomer. So wanted to mention real quick for the for people who are in the lower brackets, the taxable income bracket of 15%, if you have qualified dividends and capital gains, there's actually a benefit that was in the code and they kept in the code for the foreseeable future of a 0% rate. So for various reasons, we've had clients that have been able to take advantage of that where they've had capital gains, had qualified dividends, and actually paid absolutely no tax on them because their other sources of income were very low. Then if you get into the middle brackets there, your qualified dividends and long-term capital gains are taxed at 15%, and one of the changes that they enacted this last time was that if you are an upper income person with taxable income basically over $400,000, that rate is up to 20% on qualified dividends and long-term capital gains. So another thing they brought back was the old phase-out of personal exemptions. So for someone who makes over $300,000 or adjusted gross income, that's not taxable, but adjusted gross income of, as you can see, for a couple $300,000 or single $254,000, you now get phased out on your personal exemptions, which are about $3,900 a person. So those, again, are effectively raising someone's taxes. Just sounds a little different the way they phrase it. Another thing they brought back is the phase out of itemized deductions. And those, we've had some of our clients get confused on what exactly that means. So they reduce your deductions by 3% of the amount that your income level exceeds these set thresholds. And I'm going to show you real quick an example. But you can't lose more than 80% of your deductions. So you're going to get at least 20% of your itemized deductions. There are some things that are not subject to these phase outs of itemized deductions. Those are medical, investment interest expense, and then a little bit more rare, but casualty and theft losses. Okay, so real quick example here. We have a couple that files jointly. They have medical beyond the floor, because medical expenses have a 10% income floor. Depending on your age, it could be 7.5%. Let's say you have state income taxes of $30,000, mortgage interest of $20,000, and charity of $7,000. So this couple's income level is $355,000. So the threshold is 305, so they're exceeding that threshold by 50,000 exactly. So you take 3% times the 50,000 they're exceeding the threshold. That is a reduction in their itemized deductions of $1,500. So it all depends on one's income level, how quickly you will lose your itemized deductions. But again, that is effectively increasing someone's tax rate. So here are some things that have been very popular deductions over the last few years that were extended out through the end of 2013. They did expire. They are expected to be renewed. Congress just needs to get their act together and do so. The first thing that made a big difference here in Florida was being able to deduct state and local sales taxes, especially on big ticket items such as cars and boats. Those have definitely helped our clients over the years. Another benefit that is expected to be renewed, which is another popular one, is being able to make direct distributions from your IRA to charity. So it meets the required minimum distribution rules, but it also does not add into your income for some of those other phase-outs that we were just talking about. So that is actually a great benefit for someone who has IRA funds they don't plan to use, and they're just wanting to give some to charity. They can actually satisfy their RMD, as we call it, but also get that right over to a charity. The tuition and fees deduction is for taxpayers who may not, on income level, be able to get the education credits for college. That's expected to come back. The teacher's classroom deduction, up to $250 deduction. Another one we've had quite a few clients benefit from over the years is having debt canceled on their primary mortgages for their principal residence. That expired at the end of 2013. So anyone who's working out either a short sale or foreclosure on their personal home, it's hopeful that that will be renewed as well so that they can get that benefit back. And then also some of the energy credits that used to be more advantageous a few years ago, where they were up to 30% or a total of $1,500. They're down to only 10% and up to $500. Those are expected to be renewed as well. Okay, so just wanted to briefly talk about retirement plans and some of the limits there. Anyone who's working and still able to contribute to your 401k through your work, that's up to $17,500. Or if you're 50 or older, you can do 23 with the catch-up contribution. They've now added into the code the ability to take 401k funds and convert into a Roth. And that's been something we've had clients choose to do primarily in the IRA, not so much the 401k, but it's another way to move funds from being subject to tax to being non-taxable. And then just real quick, the traditional and Roth IRA contribution limits are $5,500 if you're under 50, and then you can do an extra $1,000 on top of that if you're 50 or older. The Roth IRAs, you have to be careful that you don't go over the adjusted gross income limits to be able to participate. Anyone in here that has a business or even rental properties, some of the great benefits that we've enjoyed the last few years for depreciation have currently expired. Again, same thing we talked about on those other tax breaks. We're hopeful that they're going to be renewed here shortly. Right now, the Section 179 expensing, which is where you can write off something right off the bat, not have to expense it over time via depreciation, that has dropped all the way from $500,000 to $25,000. The expectation is that it will go back to $500,000. And then the bonus depreciation, which was 50% right off the top, which is only on new assets. Section 179 expensing is on any assets, but not allowed for rental properties. So if you have a rental property, you buy some equipment, you can't use 179, but you can use bonus. But again, that's not currently in effect. We're hopeful it's going to be back in place by the end of the year.
Matt, I was just wondering if you've heard anything in terms of prognosticating from Congress or any commentators as the likelihood of the reinstatement of those expiring items.
Well, just in the last week or two after the elections and people knowing now what things are going to look like on January 1st in terms of the Senate flipping and the House staying Republican, the lame duck Congress has already said they're going to work to try to get things done by the end of their term. That's, of course, politician talk. So it's hopeful that they will be done and we'll know by December 31st what exactly we're looking at. But if not, it's almost certain that in early January we'll see some action. So hopefully we'll know in the next few weeks. Just wanted to run through real quick some general planning tips that can help various people no matter your situation. We always advise working with an investment advisor, if you have one, to make sure you're doing things economically first, tax-wise second. We never want the tax dog to wag the tail, or if I said that wrong. So it's the tax tail to wag the dog. So anyway, we're looking at possibly selling some things in your portfolio that have not performed well that could be culled out at a loss so that you could get the tax benefit of that against some other gains that you may have had. Randy is going to go into more depth on the Medicare surtax and how that kicks in specifically on investment gains. But that would be something, and some people say, well, I like this thing, I may go ahead and sell it for now, but I'm going to want it back. If that's true, if you wait at least 31 days, then some of these rules called the wash sale rules, where basically they say you don't get that tax loss, you can avoid those if you wait at least 31 days to buy the security back. If you are at least age 70 and a half or older, you want to make sure by December 31st you take your required minimum distribution, which is typically calculated by your investment firm. They'll tell you that, or accountants can help calculate that as well. Just a general rule, if you expect 2014 and 2015 to be very similar in terms of your income levels, try to postpone your income into 2015 and accelerate deductions into 2014 to try to accelerate the benefits tax-wise, especially if you're expecting very similar years. You might as well go ahead and get the breaks now. The next thing is, if you are a business owner, one thing that we deal with quite a bit at our firm is basis, making sure that, yes, you may have a loss, but can you actually deduct it for basis reasons? That would be a whole presentation by itself, so we won't get into all the rules there. Let me know if you have any questions. Another thing is you can use a bank credit card, not a store credit card, but a bank credit card to prepay expenses, even though you may not pay that credit card bill until next year. Another thing, again, if you're expecting 2014 or 2015, whichever way, we try to optimize taxes between the 2 years. So if you have some idea of what next year is looking like, if you already know there are things coming down the pike, it makes a big difference on whether you should be doing things now or delaying things to 2015. Assuming that they renew the sales tax for states like us that don't have an income tax, if we know here shortly, it may make sense if you're already planning to get a new vehicle that you could take advantage of the sales tax deduction on top of the table deduction. Another thing, Bob's going to talk more about gifting, but if you donate appreciated stock, you can go ahead and get the tax break on the full value and not have to pay tax on that gain that's been building up. One thing that's happened in the last few years, we have had some clients donate vehicles to charity. The rules have become a little more strenuous there. You're actually supposed to know what the charity is planning to do with that vehicle. So if they're going to use it for their own purposes, it's a little bit easier. If they're going to turn around and sell it, you actually need to stay in touch with them, and they're supposed to let you know what happens with it, because the old game was, well, I'm giving them a $3,000 car. Well, they only sell it for $1,000. The IRS was not happy with that change in value, so now you're supposed to find out from the charity exactly what happens or they plan to happen. And then all these things we just talked about, if your tax situation is impacted by the alternative minimum tax, or AMT, you may need to really get some extra help, because some of these general rules can actually be the opposite of timing of what you'd want to do if AMT applies, because AMT can effectively negate some of the general planning tips for accelerating deductions. We've found clients over the years that we've actually talked to and worked through AMT, we don't want them to prepay their property taxes and things like that, because they get no extra benefit from it. So I'm going to turn it over to Randy, and he's going to talk a little bit more about this crazy Medicare surtax.
Thanks, Matt. My name is Randy Wright. I'm the tax partner with Markham, Norton, Mosteller, Wright. We have offices in Fort Myers and Naples. I'm going to talk a little bit about the net investment income. This was a surtax that hit in starting in 2013. But before I get to that, I thought I had a couple interesting charts that I've gleaned from a seminar recently, and I thought they were very interesting in the fact that Obama and the Democrats promised to raise taxes on the high incomers, and boy did they ever. If you really look at like the taxes on the top rates on qualified dividends, pre-2013 was 15%. Today, it can be as high as 23.8%, and that's the same thing for long-term gains. Those are 59% increases from just 2012 and beyond and before. Taxable interest from 35% top rate to now 43.4%, an increase of 24%. And then on earned income, wages, sole proprietorship type income, or an active partnership that you get self-employment income from, a top rate of 40.65 to 48.15%. That's 18%. So some of our sole proprietors and that we have as clients get really surprised by this. They know the income tax rates, but they always forget about the self-employment tax piece of it. And now on top of that, there's the new there's the Medicare surtax on compensation, which is 0.9%, and an extra Medicare tax. And then, but what I'm going to focus in on more is the net investment tax. But one more chart here that I wanted to show, just kind of where do these rates hit? Who gets affected by these rates? Obama promised not to raise tax on the lower to middle class. So if you look at, if your income is below 250, you're going to fall in a 33% marginal bracket, but 15% for your capital gains and your qualified dividends. If your income is between 250 and 450, this is for married couples, you're going to be in the 36.8% tax bracket for the ordinary income, and capital gains and long-term dividends 18.8%. That's the 15% plus the new 3.8. And then for those over 450 who get impacted the most, 43.4% on your ordinary income and short-term gains, and 23.8% on your long-term gains and qualified dividends. So what is this 3.8 surtax on net investment income? For those of you that were affected, you would have been affected on your 2013. It might have been another nice surprise on top of the rates that Matt talked about. You got the increase in rates from 35 to 39.6, but on top of that, you get hit with another 3.8% on some of your other income. So it really was a double whammy for some. So we're going to talk about, when does the 3.8% surtax apply? What is the 3.8% surtax? And then what is not included in NII? I'm going to call it NII a lot for net investment income. And then some planning opportunities and what you can do to maybe lessen the blow of the tax. So the tax, what it had started as I go too far here. The tax started in 2013, and it is a tax on certain investment income, net investment income. It's 3.8%. It was enacted by the Healthcare and Education Reconciliation Act of 2010, also known as the Medicare surtax, because the legislation enacting the tax was created to offset the cost of health care legislation. Okay, when does it apply? The 3.8% is imposed on the lesser of the following: the amount by which a taxpayer's modified adjusted gross income exceeds $200,000 if you're single, or $250,000 if you're married, or the amount of the net investment income itself. Now, trusts and estates are included on the slide, but they have a much lower threshold, which we'll go over at a later time. And just a couple examples to illustrate the impact of the tax. Let's say Joe here is a single taxpayer, modified AGI of $250,000, which includes $75,000 of net investment income. So his AGI without would have been $175 plus the $75 to get to $250. So since he's single, he has exceeded the threshold by $50,000. So he has exceeded the threshold by $50,000, even though his net investment income was $75,000. The $50,000 is lower, so his 3.8% will be on the $50,000. In contrast, we'll say Tom and Mary file a joint return. They have modified AGI of $380,000, of which $115,000 is net investment income. Well, you can see from this example, they've exceeded the threshold, by $130,000. So their full $115,000 of their net investment income is going to be subject to the NII tax, the 3.8% tax. So what is net investment income, or what does it apply to? Okay? The net investment income applies to gross income from taxable interest, dividends, capital gains, annuities, royalties, rent, and then another one that people don't think about, passive activity income, such as you're investing in a limited partnership or another partnership that you don't actively participate in, or even an S corporation or an LLC that you're not an active participant in. That will spin off passive income, which will then also trigger this net investment income tax. I mentioned capital gains, but it also includes gains on the sale of, say, a vacation home or secondary residence. And in some cases, it will even apply to the sale of your primary residence, which we'll go over that example in a little bit as well. But first, let's talk about what is not net investment income. What is not is your wages, salary, compensation. If you exercise compensatory stock options, that is considered compensation and not subject to the NII. Income from partnerships, S corporations, and LLCs, which you are an active participant in. So, for example, I'm a partner in my own firm, and I actively participate in the day-to-day operations. At least I like to think so. And so my income from that S corporation is not subject to the NII tax. If I was a passive investor, I just put my money up in that same S corporation but don't participate in the day-to-day activities, then that income would be subject to. Qualified retirement plan distributions such as pensions, 401ks, IRAs, Roth IRAs, those are not net investment income. Tax-exempt bond interest is not included in NII. Even though it's investment income, it's not considered subject to the tax. Veterans benefits, Social Security benefits, those are not included in the NII. Now, gain on the principal residence, as long as it's below the exclusion limits. We'll go over a couple of examples for those of you who are not familiar. The old exclusion limits, or I would say old, but the old rule used to be if you replaced your house with a more expensive house, you didn't have to pay gain. Well, that rule went away in 1987 and was replaced by exclusions. If you're married and you and your spouse live in the house and use the house as your primary residence at least 2 of the 5 preceding years that precede the date of sale, you're entitled to a $500,000 exclusion of gain. Doesn't matter if you replace the house, go live in a downsize, or just rent from now on and don't have a new house. You're still entitled to the exclusion. You do not have to replace the house. Replacing the house has no bearing anymore on this. So, looking at an example. And the limit is $250 for someone who's single, or even a married couple where only one spouse qualifies. Maybe they're living apart and one doesn't use the house as the primary residence. They're entitled to half the exclusion. So here we go with an example. Sales price of $1.3 million. Cost of the home, including improvements and closing costs, $1.175. So a gain of $125,000. How much of this gain would be included in net investment income? Well, the answer is it depends. If it was your principal residence and you used it 2 out of 5, test was met, then none of the gain is going to be recognized as for NII purposes, because the $125,000 is going to be offset by either the $250,000 exclusion for a single person or the $500,000 married If it was not the principal residence, second residence, or they did not meet the test, say they only owned this house for 1 year and were lucky enough to have this gain, then they're not going to meet the test and they're going to pay tax on the gain as well as the new NII tax. Second example, let's say the sales price is $1.675, the cost of the home of $1.1, and a gain of $575,000. So how much of this gain would be included in NII? If married, again, and the 2 out of 5 year test is met, then only $75,000 would be subject. It's also going to be subject to capital gains, so keep that in mind. The capital gains plus the NII tax if you are over those other thresholds that we mentioned earlier, the $250 for married and $200 for single. But in this case, they would I'm assuming they qualify for the whole $500,000 exclusion, so they pay tax on the $75,000. If a single taxpayer, he's going to be able to exclude the $250 if he meets the test and only get taxed on the $325. And then again, if it's not your principal residence or you've flunked the test of the 2 out of 5, you can pay tax on the whole $575,000. So there is not a break for principal residences other than the regular exclusion, brackets. So let's talk about some planning opportunities. Now that we're nearing the end of this topic, I want to talk about some opportunities and other items that are related, to the NII. Matt mentioned before, consider loss harvesting before the end of the year. So if you have significant gains in your portfolio that you've already sold and realized, and you have some loss opportunities that that make economic sense as well as tax sense here, you can not only offset your capital gain tax, you also offset the NII tax, the 3.8% tax, also used to offset these losses. While the IRA distributions, Roth IRA conversions, while these are not net investment income, if you an IRA distribution and a Roth conversion actually will increase your AGI, which then in turn can make you subject to the NII tax. So, keep that in mind. When I was telling you before that the IRA distributions and wages and Social Security and all that stuff is not itself considered NII, those things will raise your AGI, which triggers the NII. So if you can keep your income below those thresholds of 200 and 250, then you're not even going to be subject to the NII, so it doesn't matter what your interest, dividends, and capital gains are if you can keep it under those limits. But once you reach those limits, then you're going to be wanting to look at things like reallocating your portfolio. Maybe instead of having dividend-paying stocks and interest-paying investments, that you go to growth funds, value funds, something that's not paying an immediate income. And as long as you haven't sold that investment to trigger a gain, you'll be out of the NII picture. Utilize tax-exempt bonds. Remember, tax-exempt bonds do not trigger the NII, so that would stay out of that tax as well. If you're already subject to the NII, but you find yourself in the need of cash at the end of the year, you would be better off, taking an IRA distribution or a Roth distribution versus taking, say, an annuity or selling some stocks that are going to generate capital gains now, or having a taxable annuity piece be subject to the NII. You're going to trigger that extra 3.8% tax on that as well. Lastly, I want to talk about just a couple other things. This is not on the slides, but installment sales. There was some confusion when they first passed this law of what was going to happen with some of these things that were already in our tax returns from previous years. For example, prior installment sales. If I sold something on an installment sale 10 years ago on a 20-year note, I'm still collecting on that 20-year note. Well, how is that going to be impacted for tax purposes? Well, as we've suspected, the IRS said, well, if you hadn't paid tax on it yet, that's just going to be part of your capital gain, so that's also going to be subject to the new NII rules if you are over those thresholds that we mentioned before for AGI. So and even though you might have been paying a 15% maximum rate on that installment sale in previous years, it's now subject to could be possibly to the 20% rates as well as the 3.8% NII tax. Capital loss carryovers. This one is a benefit. If you do happen to have capital loss carryovers from previous years, as if many of you might know, that if you have capital losses that exceed your capital gains, you can only deduct $3,000 a year, and the rest gets carried forward indefinitely until you either use up the $3,000 or till you offset it with other capital gains. So these capital losses will reduce your current capital gains and therefore also your NII. Suspended passive activity loss carryovers. I know we're getting a little off track here, but we touched base before that passive activities are not are considered NII. So if I had passive activity loss carryovers, meaning I had one piece of rental property and it's the only passive investment I have in my portfolio, and it generated significant losses, those losses typically are not deductible unless you have other passive income. So if I don't have passive income, there are some exceptions, of course. There's exceptions to every rule, of course, in tax law. But I would have that passive activity loss, and it would carry over to a future year. Now, in a year that I may have passive rental income, that's typically what you would see in these, is passive rental income, or those in non-participating businesses I was talking about before. So this year I generate a positive income from rents. Now if I have passive activity loss carryovers, I can use that to offset the income from that, and also then therefore my NII will be reduced and I won't pay tax on that. Also, investment expenses such as investment interest expense and other investment expenses, your portfolio trustee fees, management fees to manage your portfolio, as long as those are deductible on your tax return, then they're also deductible in computing the NII tax. Okay, I hope this information's been helpful. We'll have time available afterwards for questions, or even right now if you'd like, but otherwise I will turn it over to Bob for part 2.
Okay. Hi. I'd like to thank Randy and Matt for making a very strong case for tax simplification. And it seems like a good time to ask if there are any questions on, there's a lot of material here, so feel free, yes.
I used to have a thing called a Clifford Trust. It's no longer available. Is there anything else similar to that available today?
Bob, you want to handle that one? I'm not.
Essentially, no. That was really an income deferral technique, and a lot of that stuff was really phased out in the 90s and replaced by the newish rules on annuities and retirement plan accounts. So I'm not aware of any Clifford Trust replacements, or Rabbi Trust as well in the past. Right. And so sorry. Anyone else? Okay. I just wanted to point out there are we have a larger presentation, some additional slides built in with a lot more information. Particularly Randy and Matt left a lot out because there's just so much info. And if you're interested, you could also, in addition to that, we have an outline of the presentation. So if you'd like to receive it, just go ahead and add your name and address or email address to the sheet on the table, and we can send that to you afterwards. So with that being said, just to remind you, my name is Bob Kleinknecht, and I started Oakstone Law as a boutique estate planning and estate settlement law firm. I've got about 15 years experience in estate planning, estate settlement, and most recently spent about 8.5 years as in-house counsel to a family office, working primarily on their matters. I started Oakstone as a way to start bringing on additional clients to help them with their long-term trust and estate planning. So with that being said, this time of year, in addition to the income tax planning, a lot of our clients are concerned with gift planning and how to make gifts, and what types of gifts, how much, how frequently, and often those gifts are in trust. So I'm just going to cover some of the basic numbers first on annual gift planning and lifetime gift planning, and then I'll get a little bit into the trusts, and then when I'm finished, Matt and Randy will pick up and talk a little bit about how tax and trust interact, and then we'll talk about some additional, a little more advanced planning techniques after that. So with that being said, the first part I'd like to talk about is gifts to family. I've kind of broken into two parts, gifts to family and gifts to charity. We'll talk about gifts to family first. And a lot of people want to talk about how much can I give to my family without running afoul of IRS rules. And the first one I like to start off with is first of all, let me back up a little bit. There is a gift tax that limits the amount of gifts that can be made to any individual and to family members. But before you even get there, there is an unlimited exclusion for health and education expenses, as long as those expenses are paid directly. And by paid directly, I just mean if you write a check to the University of Florida for tuition for a child or grandchild, that is not considered a gift or a taxable gift that's counted for purposes of IRS computations. It's often overlooked in the sort of $14,000 a year, which I'll talk about in a minute, analysis. Also, health expenses, as long as they're paid directly to the doctor or to the hospital. That does include paying directly health insurance costs for family members, or frankly for anyone, friends, family. So what does not work, and which is a common mistake, is if I reimburse someone for their college expenses. So someone, let's say I have a child and a grandchild, and my child pays the grandchild's tuition expense, and then I reimburse my child. That's sort of a no-no. So if you want to take advantage of this unlimited exclusion, certainly pay the cost directly to either the educational institution or the medical provider, and there's really nothing to count or report or tally up here. So that's something I like to point out at the beginning. Before we get into this next part, which is what's called the annual exclusion, and you've probably seen this, and it's the $14,000 a year number. It used to be 13, before that was 12, 11, 10. It's indexed for inflation at a weird rate, but suffice it to say it's $14,000 this year and will be again next year in 2015. And that's for one person to one person. So if you're married, you can give $28,000 to any one person, and that's called gift splitting. The gift splitting is a little tricky in that if I give $28,000 to my daughter and I'd like to split that gift with my wife, then I am technically required to file a gift tax return to take advantage of that splitting. It's actually a box you check on the front page of the gift tax return to elect the splitting. One way to get around that is to simply write two checks, and then she can write a check and I can write a check, and we're both at the $14,000 mark. So same economic result, one less tax return to file. So that's kind of a common mistake to avoid. There may be many cases where you'd like to actually do the gift splitting and file a return, and I can get into that a little bit later, but just point that out for now. The next question that comes up with this annual exclusion is, well, I'd like to give $14,000 to my grandson, but I'd really like to give that to a trust. I'm not sure I want him walking around with that money. So generally speaking, the annual exclusion does not apply to trusts as a general rule, but there's a huge but here that you can drive a truck through, and that's called a crummy trust and a crummy power trust. And this is a type of trust that you'll write the check to the trust, but the trust provides a withdrawal provision so that the beneficiary of the trust can actually have a 30-day window to withdraw the amount of the gift. And let's say there are 10 beneficiaries of the trust. This is a very powerful tool. You could conceivably, a married couple could write a $280,000 check to this trust, and if you have 10 beneficiaries, each of them could withdraw their pro rata portion. How does the withdrawal work? Well, you have a 30-day or 60-day window, usually 30, and it's usually the end of the year, so it's the last 30 days of the year. So let's say I write a check on November 28th. The trustee is informed, and the trustee then just notifies the beneficiaries. If they're minors, you notify their parents, then that they have the ability to withdraw, and of course you have the conversation with them at the same time saying, we highly recommend you don't make this withdrawal, or there may not be any other gift to this trust in the future. So that is a way to, again, this crummy notion, this crummy power is taken from the name of a case called Crummy v. Commissioner, a 1968 Ninth Circuit case, in which this power was essentially created. Before this power existed, you simply couldn't get the annual exclusion for gifts to trust. So again, it's a way to get this annual exclusion benefit using a trust. And the essential point here is the reason you need the crummy power is because if I write a check directly to an individual for $14,000, they cash the check, that's called a present interest. They have the ability to currently enjoy the property, use the cash. if I write a check to a trust that may or may not provide them benefits in the future, then that's not a present interest. And the code says that annual exclusion is only available for a present interest. So by giving them the withdrawal power, we give them a present interest. So they have 30 days to use it right now. And that's enough to trigger the annual exclusion. So that may be more than you want to know about crummy trusts, but that's a very powerful tool to really magnify the amount of annual exclusions that you can give, and also keep it sheltered and protected inside of a trust. So in addition to the annual exclusion amount, there's something called a basic exclusion. And of course, it wouldn't be the tax code if it wasn't littered with words like exemption and exclusion, but this is sometimes referred to as a lifetime exemption. And the number you see in the papers these days is sort of a $5 million per person, $10 million per couple. And as you can see from the chart, it's really changed over the years. And for many, many years, back in the 90s and 80s, it was around 600,000. In 1997, there was a Taxpayer Relief Act of 97 that ratcheted up from 625 to 650 to 675 in 2001. And then we see what happened effectively coinciding with George W. Bush's presidency. The amounts really ratcheted up in the 2000s, and you can see how they kind of ramped up. And then we got to that weird year in 2010 where no one was quite sure if repeal was going to happen. The law was, in fact, quote, sunsetted. There was a sunset built into the 2001 law that said this thing's going to end in 2010. And of course, Congress acted and gave us $5 million exemptions. Well, it would be nice if it were that simple, but in fact, the $5 million is also indexed for inflation and goes up a little bit each year. They don't index it the same way they index the 14. So the 14 stays the same in 2015, but as you can see, in 2015, the $5,340,000 is now going to be increased to $5,430,000. And the $14,000 annual exclusion is called an annual exclusion because it resets every year. I can give $14,000 to the same person every single year. This basic or lifetime exclusion is a cumulative amount, so once I've used it, it's no longer available, and that goes for, it's tied in with the estate tax as well. So if I gave away $4 million during my lifetime, and then at my death, I have another $1,430,000 before the estate tax will kick in, and I hope that makes sense, but that's the big difference between the two. Obviously, the numbers vastly increased to the point where 99.3% of all people will no longer have to be concerned with gift or estate tax, especially if married, because you'll now have effectively have a $10,860,000 exclusion between you. How does this impact people? The one thing there's a concept to talk about here, and it's called portability. And I won't go into great detail here, but it used to be that if you had a married couple, and let's say it was 2002, and there was a $1 million exemption, and the first spouse to die had no assets in her name. That $1 million exemption for her would effectively be wasted because there were no assets to sort of soak it up, so that when everything passed to the husband and the husband died a few years later, his estate would include the wife's estate, but he still only had the $1 million exemption. So what we did was we called it credit shelter trust or AB trust planning, so that the first $1 million would pour over into a separate trust, a credit shelter trust, an exemption shelter trust for just the family, sometimes the spouse as well. So then you'd end up with a marital trust and a credit shelter trust, and that was a way to preserve that first exemption amount. What happened as these things ratcheted up is we ran into some difficulty with the way a lot of those trusts were drafted. So if you had, and the terminology used in these trusts was essentially the largest amount which can pass free of estate tax shall be given to my trustee to be held in the family or credit shelter trust. The balance will go to the marital trust for my spouse. And again, the family trust may or may not have the spouse included, so in cases where it did not, a lot of times in second marriages, for example, with that language and with these exemptions ratcheting up to $5 million, a person with a $4 million estate would see the entire estate pour over into this family trust, of which the spouse may or may not be included. And you can see that's a great way to have angry spouses. So one of the things to watch out for is if your documents were drafted pre-2012, 2011, most planners had it figured out in the 2010, 2011, 2012. They were sort of planning for all possibilities, but it's just something to keep an eye out for. So that's a lot to go over with the exclusion amounts. But the general thinking is, well, I have a $5 million exclusion, I don't need to worry, or I have a $10 million for married, but you do kind of want to take a look at your documents, especially if they're 5, 6, 7 years old, number one. And number two, in order to take advantage of that portability, an estate tax return now needs to be filed at the first spouse's death. So if there's a $6 million combined estate, the first spouse passes on, but let's say maybe she doesn't have very many assets in her own name, you would file an estate tax return to preserve her exemption so it's not later wasted. And there's lots of different rules on that. The point was, so that I could take my $5 million with me, whether I had the assets or not, and really simplify things. However, it's created, of course, its own set of complexities. And I'll just move on from there. Types of gifts is really, the types of family gifts in particular, is really the next part I'd like to talk about. And this is pretty straightforward, but there are any number of ways to make a gift. The first simplest concept is cash. I write a check, that's a cash gift, wire transfer. Marketable securities are typically treated the same as cash under the tax code. It's just the value of the gift is the fair market value of the security on the date of the gift. So a couple of points here. If you're going to make a cash gift, just document the gift. Get a copy of the canceled check, maybe a copy of the statement showing where the check cleared or where the wire or stock transfer came through. If you can accompany the gift with a note or a letter, that's nice too. You've got some documentation to go along with the gift. The point is you want to be able to keep track of these things because, again, gifts are cumulative up to the point of the estate. So when there's an estate tax return, one of the first things you do is take a look at all the lifetime gifts, and it's really difficult to do without that documentation. And again, the burden is almost always on the taxpayer in these cases. So if you're trying to document that I only made X amount of gifts, you're going to need to be able to demonstrate that with some written documentation. Just a quick note on the timing of gift, particularly with checks. A lot of this happens quite a bit where clients like to make gifts during the holidays, so Christmas or Hanukkah, or the checks get handed out on December 25th, and everybody is happy, and then a week or two goes by and they cash the check. Well, the rule for gifting is that gifts to an individual, for gifts to an individual, the gift is considered made when the check is cashed, not when it's dated or actually handed over. So it's not a completed gift until the check is cashed. So the check's not cashed till the 2nd of January. That's a 2015 gift. So that's just something to keep in mind. So if you wait until December 25th, just be very clear to tell everybody cash the check right away, which in many cases is not really a problem. So I'd like to talk about some other types of gifts. I'm just checking the time here. Okay. Other property, real estate, artwork, jewelry, cars or boats. The common mistakes here are just poor documentation. So let's say you give the Picasso to your daughter, and your daughter has a sister who later insists that, Mom only said you could borrow the Picasso, not keep it forever. So these are the kind of disputes that arise. So just a general recommendation here, common mistake, have good documentation of your gifts. If it's something like a boat or a car, actually transfer the title. Just handing the keys over is essentially ignored in the law. If there's a gift of a painting or artwork, you're going to be concerned about things like provenance. So just keep an eye on documentation and making sure that sort of the chain of title is clear. If it's a gift of real property, it's pretty basic. It's a deed. You actually have to transfer the item or it's not a gift. The other common mistake here is poor valuation. So when you make a gift of a home, for example, you really want to get that thing appraised. Spend the $300, get a good number. You'll be glad you did it years from now when you're trying to document the value. Especially if there's any kind of partial interest involved that can get, and again, the burden's always on the taxpayer here to prove value. The common mistake here is, well, I've got a letter from my friend who's a realtor, and to the IRS, that's not really worth the paper it's printed on. So you really do want to take the time to get a good valuation for assets other than cash. Another type of gift that comes up in families with significant wealth is what we call discounted interest in entities, family limited partnerships, family limited liability companies. And I won't go into great detail here, but we can have, if you have questions on it, feel free to ask. But the concept is taking assets and dropping them into an entity such as a limited partnership or a limited liability company, and then making gifts of pieces of that entity to family or to trust for family. The concept here is if I put $100 into this bucket and then give pieces of the bucket away, the pieces that I give away, because they're minority interests and they lack control over as many of you who are investors in limited entities know, you generally don't have control over the choices that the general partner or the manager of the LLC makes. So if I give a limited interest away, the value of that, say $30 interest, is something less than $30 because of something called minority interest and marketability discounts. And so that $30 interest might be worth, for tax purposes, $21. So you made a $21 gift, but you got $30 of wealth to the next generation. So if there are any questions on that, we can get into it, but I'll move on for now. Another type of gift was really popular several years ago. It's a very circumstances analysis at this point, but basically 529 plans, college saving plans, allow for accelerated annual exclusion amounts. So the long and the short of it is, I can make a $70,000 gift to a 529 plan, which effectively uses up 5 years worth of $14,000 annual exclusions. I can do that all at once. If I'm married, I can do $140,000 all at once as a way to sort of pre-fund the college plan. You do have to file a gift tax return, let the IRS know that's what you're doing. You've used 5 years worth of your annual exclusions. So if anyone's interested in that, we can talk about that. The second part here is gifts to charity. And a lot of people are concerned about this at the end of the year, and of course usually the impetus here is a bit of a tax deduction. So you'd like to get those in by the end of the year. The first type here is just direct gifts to charity. Direct outright gifts to exempt organizations is pretty straightforward. You're going to write a check, you do a wire transfer, maybe transfer some shares of stock directly to the organization. I'd just like to run through a few of the common mistakes here, though. Number one, make sure your charity really is a charity. There's been a lot going on in recent years, particularly with so-called, 504C, the political organizations, and other organizations losing their exempt status. So go to the IRS lookup service, go to something like guidestar.org and look up your charity and make sure it has an IRS exemption letter. If it does not have a valid exemption letter, your gift to the charity is not a charitable gift, it's a taxable gift. So if you make a substantial gift to an entity that's not a charitable org, you have potentially a gift tax implications, not to mention your charity is in trouble. So gift of anything other than cash or marketable securities, and by marketable securities I just mean publicly traded stocks and bonds, things you can look up on Morningstar or what have you. Those gifts other than those, gifts of property, gifts of things that we talked about earlier, gifts of pieces of perhaps artwork or discounted interest in entities. All of those require very special handling, and there are certainly appraisal requirements. There's a whole section of regulations on what's called qualified appraisals. And so it's just something to watch out for. Another common mistake is failing to get a thank you letter. Most charities, it's pretty automatic. They'll issue a letter saying thank you for your gift of X. But in order for the gift to count, you really do need to have that letter. So if you don't have documentation from the charity that they received the gift, you need to get in touch with them and make sure you have it, because if you don't have the confirmation, you don't have a valid charitable gift. And a last common mistake here is the sort of the events, the charitable events, the galas, the balls, the table. You might buy a table, you might buy tickets to the event, and you've probably seen as a footnote on the letter somewhere it says it'll either say the charitable value portion of this gift is X, and they'll give you a dollar amount, or they'll say the value of the food or the meal that you received at this event was $200, say. So it's a very important concept that if you pay for something from a charity, the value of what you get back is just simply not a donation. So just something to keep an eye on. The value of your donation is the value of your check minus any benefit that you receive back. So we've got some, oh, sorry, I guess I could have put that up a minute ago. And again, if you'd like copies of these, just let us know. The next section is sort of indirect and structured gifts to charities. And the first part of this I'd like to talk about is something called donor advised funds, or DAFs, which is really kind of a new version of the old community foundation. And of course, Collier County has a pretty robust community foundation. Lee County does as well. And the concept here is sometimes we call it a poor man's private foundation. But you'll take a substantial, maybe you'd like to make a large gift in 2014, December, for tax purposes, but you're not really sure which charities you'd like to receive it just yet. So you can make a substantial gift. The donor advised fund will hold an account for you, and then the donor advised part means you as the donor will serve as the advisor over the account going forward, and then you'll recommend to the donor advised fund which charities the DAF should make payments to. And the DAF, or the community fund, community foundation, is not technically required to honor each of your requests, but they do know that they'll be soon out of business if they don't. So we call it donor advised fund because you actually are transferring the funds and the ownership of them to the donor advised fund, but you're retaining the right to recommend grants. A couple of common mistakes with these are, number one, assuming you'll have full investment control. So if you make a $100,000 gift to the community foundation, you just want to talk to them beforehand. If you're assuming that you'll be able to direct how those funds are invested, that may not be a safe assumption. I just pointed out it's a conversation worth having. And also, a lot of times families forget to name a successor advisor. So I might have the right to tell the donor advised fund to make gifts for the rest of my lifetime, but what happens then? Should my spouse have the right to follow on? Should my children have the right? And that's, again, a conversation to have with the sponsoring organization. Occasionally, Congress talks about adding a requirement. Now, with a private foundation, if you establish a private foundation, it's a very complex organization. And you've probably heard of the Bill Gates Foundation, the Ford Foundation. Those are essentially private foundations. The rules enacted in the 60s for those say that those have to give away 5% a year. They can't just simply hoard and hold after receiving the charitable deduction. Donor advised funds don't currently have that 5% rule. So theoretically, the funds could sit in a donor advised fund for many, many years without being paid out. The reality is that they do tend to pay up to 16% a year nationally. Which they're very much frequently offering that information to Congress, because occasionally Congress talks about adding a 5% rule to the donor advised fund. So it's just something to keep in mind when you make a gift. The next kind of structured gift is charitable trusts, or charitable remainder trusts, charitable lead trusts. And I kind of call this having your cake and eating it too, because again, you're making a large upfront gift to an entity. You're receiving an immediate tax deduction in most cases with these trusts, but you're really delaying who the ultimate charities will be. And you can use these trusts to, for example, a charitable remainder trust, you get the immediate income tax deduction, And then a payment comes back to you as the donor or to your spouse for life or for a term of years, and then the remainder at the end of that time period would then pass on to charities of your choosing. And you have the ability to actually change the charity as you go, as they come in and out of favor. A charitable lead trust is sort of how it sounds. The charities receive the annual payment, and then the remainder will pass on to family, typically. And again, you usually get an immediate income tax deduction for those. There are a number of common mistakes, really too many to list with these because they're really sort of technical. But they're a very common or a very popular tool for low basis assets. When something that's substantially appreciated, particularly people that have started a business and essentially have zero basis, and then eventually they're selling the business, having a liquidity event. A lot of times this vehicle can be used to hold those shares, and then the trustee can actually sell the shares and trigger zero capital gain because it's a charitable entity. And then essentially with the charitable remainder trust, you're ensuring an income stream back to the donor. So again, fairly complex but very powerful in certain circumstances. Private foundations, the common mistake here is assuming you need one. They're pretty expensive to run. Again, there's that 5% drawdown rule, but essentially you're creating your own quasi-charity. It's a great tool for families of very substantial wealth because really all the options are on the table for them as far as investment and distribution and grant making. But it's just another way to structure your charitable gifts. And types of charitable gifts very similar to types of family gifts. This section, for example, cash and marketable securities. These gifts are pretty straightforward, but there are a couple of issues here. So let's say you make a gift. First of all, there's the income threshold that many of you might be aware of. If you make a large gift, your deduction is essentially limited to half of your current income. It's a little more complicated than that, but if your gift exceeds half of your income for that year, you'll roll the rest of that gift forward, and you'll have what's called charitable carry forward, and you can deduct the rest in future years. So it's just something to keep in mind. That surprises people from time to time. Also, something that surprises people is what I'll just call capital loss property for this purpose, and that just a reminder that the deduction for appreciated property, stocks, and bonds is usually the lesser of your basis or fair market value. So if you actually have something, if you're donating appreciated property that's currently worth less than what you paid, your deduction in a lot of cases is limited to what you paid and not the current value. So just something to take a look at before you make a gift of appreciated property. Speaking of appreciated property, other items like real estate, artwork, cars, and boats, Again, you do have that basis, that deduction limited to basis in a lot of these cases because it's not marketable securities or cash. One of the things that catches people by surprise is if you receive a gift from an artist, never accept a gift from an artist if you're planning to donate that gift down the road, because your tax deduction is limited to basis. So if the artist gives you a painting, his basis becomes your basis. And of course, his basis is the $8 he paid for the canvas and a few dollars for some paint. So just something to keep in mind. Another item that has sort of come in and out of favor is the concept of giving pieces of real estate, and something that became almost it really was a promoted item in the early 2000s was the facade, the gift of a facade. So I'll give you the front of my building to the town. For example, I'll never change the front of my building, and I can sort of slice the value of the property and figure out what that's worth and take a deduction. Or I'll give an easement through this swath of my property to this nature preserve foundation and receive a deduction for that piece. I've still retained the use of most of the property, but these are very highly scrutinized at this point. So if you're considering a gift like that, if someone is promoting that type of a gift, just be careful with those, because there are a lot of rules now and a lot of cases where the deduction is ultimately denied. And it doesn't sound maybe too scary, but the way it works practically is you file an income tax return, you list your deductions, and then you pay your tax accordingly. And then 3 years later, when the service gets around to auditing your return, they decide your charitable deduction was invalid. So now you've got interest, and if it was large enough, you've got penalties for under-reporting your income. So it's just, again, I'm just trying to point out some common mistakes and things to keep in mind. Another thing that was very popular was partial gifts of artwork. So I've got a Picasso, and I'm going to give half of it to the Metropolitan Museum of Art. Only I'm going to keep the painting part, and they're going to have, occasionally I'm going to allow them to display it on the wall, and when they're not displaying it, I'll have it right in my house where it always was. And that was a way to give, say, half of the painting. It was a very successful tool for a while, but it's essentially dead at this point. You can no longer do that. There are a number of limitations that actually take the game off the table. So with that, we've got just a little section on trust planning, beginning with the brief overview, not to put everybody to sleep, but the income taxation of trusts. So I'll hand it over.
Thanks, Bob.
Sure.
Just going to keep this pretty brief and basic, but the income taxation of trusts basically are going to depend on whether it's a grantor type trust or a non-grantor type trust, and whether or not you even have to file the Form 1041, which is where you report trust income. If it's a grantor trust, if a grantor retains certain powers over the trust, or the grantor is treated as the owner, and it is taxed on the income. So that's typically your irrevocable living trust that people set up. They would not even require a separate tax filing. Everything's going to be reported in the grantor's Social Security number for tax purposes, and they're just going to include it on his 1040. But let's say, or if the grantor retains a portion of control, well, then that portion is treated as a grantor trust. And if the grantor, though, is not his own trustee, say the person's getting elderly and they turn over the trusteeship to a child or a bank or whatever. You see a lot of banks as corporate trustees. Then there is a 1041 filing requirement. However, all the 1041 is going to include is a big schedule to tell the grantor what he needs to include on his 1040. It's not a typical 1041 pass-through. But if it is a pass-through type or taxable trust with the trust as the taxpayer, then there is going to be a 1041 filing requirement. And I want to talk about the tax rates that apply to trusts. These are the 2013 brackets, but 2014 has only inflated a couple $100. But you can see here, we talked about earlier, an individual married couple hits the highest bracket at $450,000 worth of income. A trust hits it at $12,000 worth of income. You're already in the top bracket. And not only that, the 3.8% NII tax that I spoke about earlier also applies to trusts. So trusts typically have NII type income. They have interest, they have dividends, they have capital gains. So all that's going to get hit at another 3.8%. So you're talking about the top tax bracket of 39.6 plus the additional 3.8. So getting up to that 43.4% in the trust right away. So how do you avoid these tax on these trusts? And typically, I'll give you just a quickie example, and I apologize, there is a typo in here. The last column under DNI there, that should be under expenses should be 2,000, so 3 minus 2 is 1, not 3 minus 1 is 1. But in any event, typically a trust is going to have an income beneficiary and then a remainder beneficiary. As Bob talked about earlier with the charities, and those charitable trusts, there's an income beneficiary, namely the person who made the gift originally, and then the remainder goes to charity. And a lot of trusts are set up with let's just use the most common example. Husband dies, wife is named the income beneficiary of the trust, and the kids are the remainder beneficiaries. Well, you want to get that income to the wife so the tax does not stay in the trust at those high rates. So typically what happens is the trust instrument, which always controls in these tax situations, the trust instrument, if it's silent on any of these things, there are rules that apply by state statutes and whatnot. I'm not going to get into that, but if the trust document states that something is income, well then it's income. If it states that it stays principal, then it stays principal. But the way it works is, in this example, a trust instrument allocates dividends to accounting income, capital gains to principal, and has administrative expenses that they'll split half and half between income and principal. So walking through the example here, dividends of $3,000, capital gains of $4,000, and expenses of $2,000, nets an income of $5,000. But how does this get taxed to the income beneficiary or the trust itself, which is being held for the remainder beneficiaries? The accounting income is the income beneficiary piece, and that includes the dividends. Since capital gains are principal, they're not passed through to the income beneficiary. They stay in the trust and get taxed to the trust. The expenses here for the income person is half of the expenses, as noted above. So that's $1,000. So the income beneficiary, in this case, will get a distribution from the trust of $2,000. However, they're only going to pay tax on $1,000 because the IRS allows the DNI, with the distributable net income, that's passing through. They allow all of the expenses for taxable income purposes and DNI purposes, and that's where you get down to the 1. So $1,000 will show up on this beneficiary's K1 from the 1041. That's how the income is reported through the trust to the income beneficiary. They'll get a Schedule K1 from the 1041, and it'll show, and basically on this one it'll show $1,000 of dividend income on that tax return. The principal, what happens to the rest, the other $3,000, that's the $4,000 capital gain, is going to get taxed to the trust itself. There's a small exemption amount in there of $100 or $300 depending on the type of trust, but that gets taxed to the trust. So depending on, in this case it'd be very small because, going back to the previous slide, the tax rates for trust start at, it's 2450 is the 15% bracket. And if you recall back to Matt's original presentation, if your capital gain, if you're in the 15% bracket or lower, your capital gains get taxed at that favorable 0 rate, and only the amount that exceeds the 15% will get taxed. So in this case, it'd be a very small tax. But I mean, if you add a 0 or 2 to some of these numbers, you're talking about big dollars for these trusts. So they want to try to avoid as much as you can having the tax stay in the trust. You want to pass it out to the beneficiaries, the income beneficiaries, if possible. So that's all I'm going to talk about. We can go on all day about trust and taxation of trust, but I'm going to turn it back over to Bob to go over some other trust concepts.
Okay. Thanks, Randy. I'll keep this brief. Really what I kind of wanted to hit on here is that with those accelerated brackets, it gets expensive quickly to tax income inside of a trust. So when we do estate planning, we use something called a grantor trust, and as Randy mentioned, a grantor trust is essentially ignored for tax purposes. So if I set up a trust, put assets into it, the income that the grantor trust, if I retain the correct powers, it will be treated as owned by me, and all of that income is simply reported on my return. So when we do a lot of estate planning, we want to make sure that if we put assets into a trust and we interact with that trust, whether by selling assets to the trust or in some cases lending or borrowing, what have you, we don't want to create an additional tax layer. So it's important to create your lifetime planning trusts so that they have this, have this grantor trust aspect to them, so that the transactions between myself or my spouse and the trust are essentially ignored. So if I do sell an asset to a grantor trust that's a low basis asset, there's no gain on that transfer. And again, that's a function of something called grantor trust status. And if there's a bit of a disconnect between the income tax and the estate tax and the gift tax here, in that the trust for income tax purposes is, again, it's treated as owned by the grantor and therefore ignored. But if I make a gift to that trust, it's considered a completed gift and very much respected for gift and income tax purposes. So these things, you may occasionally hear the term intentionally defective grantor trust, or IDGIT, which is a horrible acronym, but the idea was that for income tax purposes, they'll be ignored So they're sort of quasi-defective for income tax purposes, but they're intentionally so because of the gift and estate tax benefits that they permit. And just to give you a quick example, I can make a $100,000 gift to a grantor trust, and now it's got a little bit of seed money, and now I can sell it perhaps a multi-million-dollar LLC, which contains a number of assets on an installment basis over, say, 10, 20 years. And then what I've done is move that large asset into the trust and all of the growth and appreciation on that large asset. I've moved that down to the next generation. I'm certainly receiving, in many cases, a relatively low interest payment back from the trust, which it can use its seed money to cover. So all of that transacting with a grantor trust is ignored for income tax purposes, which is definitely a plus. And the last thing I really want to cover here is we've done a lot of talking about trusts, and many people consider trusts to be fairly rigid. Why would I use a trust to make gifts to my children or grandchildren? Shouldn't I just give it to them? Why would I want to sort of tie everything up in trust? And a lot of people view them that way. And the benefits of using a trust are pretty clear. Number one, you're protecting assets from creditors, which in most cases, frankly, involve a divorcing spouse. So I can protect my daughter from her future ex-husband, God willing, nothing goes wrong, but 51% of marriages end in divorce. So one of the ways to protect her from that is through using a trust. Or let's say she starts a business that goes belly up. Her personal assets in the trust will be protected from that liability and any other liabilities such as a lawsuit, creditor action, bankruptcy, that sort of thing. So there are many, many benefits to using trusts, but a lot of people are concerned about the rigidity of using a trust. So one of the things I like to emphasize is the ways to build flexibility into the trust. And many people don't realize that my daughter can be the trustee of her own trust. And as long as the distributions to herself are limited to a particular standard, which we refer to as health, education, maintenance, and support. So she can act as trustee and effectively quasi-owner of all the assets in the trust and really be very similar to outright ownership, but still have all that protection built in. If she needs to make large or unusual distributions to herself, she can always add an independent trustee, whether it's a corporate trustee or another individual that's not related to her. She can also have a withdrawal power. For example, she can have the right to withdraw 5% a year from the trust. So an additional way to access the trust assets. Other ideas of trust flexibility are the ability for the trustee to create carve-out separate trusts for special assets like a vacation home or a new business to further protect the remaining trust assets. And then another way to build in flexibility is to consider the idea of a trust protector, or again, the independent trustee, which is an independent third party that can sort of step in if changes are needed or if something's gone wrong, as a way to allow for further flexibility. Because one of the things you have to keep in mind with trust is you're creating an entity that's going to continue on for many years in the future. So, and just to really wrap up here, there are a number of different types of trusts. You may have heard the term spendthrift trust. It's kind of a misnomer. It used to be a trust that was created for someone who was a spendthrift. In other words, we want to restrict these assets so that he or she can only spend a certain amount per year, subject to the trustee's control, in many cases a third-party trustee. That's still very much a viable planning tool for people for whom you have this concern. But spendthrift trust has also become the term used commonly for that sort of protection trust, protection from predators and divorce and that sort of thing. You may have heard the term IRA trust, especially recently. There was a recent case in which a daughter inherited an IRA from her mother. And IRAs are generally protected from creditors, but the daughter ultimately went bankrupt. And in the bankruptcy proceeding, the daughter tried to assert that the IRA was protected. Well, the bankruptcy and in the court proceeding, the court, excuse me, determined that the inherited IRA was not protected from the daughter's creditors, which was kind of a landmark decision just this past year. So one of the things that people are doing is now saying, well, you need an IRA trust. You need to wrap this IRA in a trust to give it that protection. My sort of thinking on it is you don't necessarily need a new trust, and your revocable trust, if that's part of your estate plan, can certainly be designed to handle this kind of thing. But you may see articles, or a lot of articles in the papers about why you need an IRA trust, and I would just say take that with a grain of salt, because there are a number of tools that can be used to protect IRAs beyond a whole separate trust to be brought into your financial equation. And just another quick item, GRATs, you may have heard of these, Grant to Retain Annuity Trust. It's a way to deposit an appreciating asset into an entity that can then transfer the wealth down again to the next generation without any gift or estate tax. It's got certain limitations, but it's a very effective tool. And that's really it. Health Education Expense Trust is just a way to take advantage of that unlimited medical and education expense gift planning. So with that, are there any questions for Matt or Randy or myself? No? Okay, well, thank you very much for coming. Yeah.